So Ravi, what else to your mind right now is in that curve of high growth and attractive valuations? Because that's the perfect combination. Get it right on price and bet on the growth because future is bright.
So within financials, of course, we've been bullish on the lending companies, but non-lending financials are also at a very interesting juncture. See, India has brought into its fold almost 40% of the unbanked population in the last 5-7 years. There is a move away from hard assets, physical assets like real estate. Real estate and gold form a disproportionate portion of the majority of Indian households. Now there is a move away from it towards financialization. So there a lot more money is going to flow into financial products. So non-lending financial companies are at a very interesting juncture. And whether I say it's the insurance companies or the wealth managers or the capital market related plays, these are all still suffering from the correction of the last 2 years or the last 3-4 years, where there were some regulatory kind of pressure on the company, or there was exceptional pressure on the yields, which was leading to the companies not performing. Now, some of the pressure is relieving, like we saw in the case of AMCs, that, okay, the regulator took a pragmatic view and decided to hold back and take the industry's feedback. So just like that, on the insurance front also, there was a hang on the a particular company from promoters selling. They took back. So all those overhangs are now going away, which is leading to this space also suddenly becoming very, very attractive. So I would say within the financials, non-lending financials are probably at a slightly better risk reward at this juncture.
So would you be looking at doing the following, reduce the exposure to corporate banks and maybe shift towards AMC or insurance or NBFCs, or you've already done that?
No, we are not looking to reduce the exposure on the lending side, but we are definitely looking to increase the exposure on the non-lending side. So it is not a either or call for us. In fact, we are bullish on both the spaces.
So you'll have to sell something to buy something because that's how portfolio allocation works, right? So what would you be selling?
We are lucky we are getting inflows, so we don't have to really sell anything. And just like all the money is coming into the market, we are also getting some good flows, and that is leading to us increasing exposure on the non-lending side. But having said that, of course, yeah, we are at the margin. Some of the stocks that have done brilliantly over the last 6-12 months, we are trimming a little bit and creating space for some new bets.
You were bullish on manufacturing, you were bullish on alternate energy, you were bullish on financials. We've discussed financials. What about the other two themes? Especially energy transition. We spoke with you when we had visited the factory of Wari. What is the update there? What is happening in that space? Because now it seems to be the pet theme for everybody.
Yeah, I mean, I think this is a theme that is going to sustain for another 10 years, maybe more also, but let's speak about next 5-10 years. And if that is the case, solar is going to be the backbone. In fact, other places like wind are also doing well within that theme. So, but as a investment opportunity, still it has not opened up for the listed market investor. There are still some bets available on the unlisted side. Listed space does not lend itself to investing. So the theme is there. We'll keep our eyes and ears open to see where the opportunity arises, but one has to be constantly focused on this space because the maximum amount of money that is going to be spent in the world in the next 10 years is in the energy transition space. So the opportunities will come. You keep your eyes and ears open.
Talk about manufacturing, and some of the EMS stocks have done rather well. Public information, some of your portfolio companies have done rather well. Do you think this EMS space is now looking like a mini frothy bubble, or it has a long way to go?
So as I mentioned earlier, clearly, there has been some returns have been far sooner and far more than what we had expected. But at the same time, the absolute size of these companies are still very small. See, they are all within the range of 1,500 to 3,000 crore kind of a revenue company and 100 to 200 crore kind of PAT. I feel these companies are going to go to minimum 500 to 1,000 crore kind of a PAT over the next 5-year horizon. So you can have 6 months of underperformance or any such thing, but I don't think it's the time to get out of this space. These companies will become far bigger from here as well. manufacturing overall is at a cusp where we are witnessing a gush. The order books are filling up very, very fast. The conversions time is reducing dramatically, and companies are able to pitch to the best against the best in the world and yet win orders. So that tells you that Indian manufacturing is really, really coming of age. So I will not be in a hurry to call the top of the theme so soon. If you see, I mean, it started in 2014 with chemicals. Chemical manufacturing was the first one to pick up. That theme ran for 7 years, and most of the companies, the worst performing stock in the sector was a 10 bagger. The best performing was probably a 150 bagger. So with that kind of returns in the offing, why would you want to sell just because it has gone 2x, 3x in a very short span of time? So we are very, very bullish on the manufacturing space. Within that electronics manufacturing space, the entire sector will grow at 25% CAGR. Possibly some companies can grow at 35-40% CAGR with inorganic also. So far larger companies are going to be coming out of this space with a far bigger profit number. So let's wait and see how this space evolves.